To IAS 1. What is IAS? International Accounting Standard 1. And it is called Presentation of Financial Statement. It is similar to which Ind AS? Ind AS 1. Ind AS 1 is also called Presentation of Financial Statement. In fact, Ind AS 1 and IAS 1 are very similar. The numbering system in IFRS is that first 41 standards will have a prefix of IAS. First 41 standard will have a prefix of IAS, and thereafter the prefix will be IFRS. Okay. So total up to IFRS 17 have been issued. IFRS 17. What is IFRS 17? Insurance contract. IFRS 16 leases. IFRS 15 revenue. So whatever is applicable in your Ind AS syllabus will also be applicable for your GFRS. Okay. So for the timing only say Ind AS 115 is applicable up to Ind AS 115. So even for GFRS also your applicability will be up to 15, IFRS 15. So this syllabus will move as your Ind AS syllabus would move. If you have studied Ind AS 1, then this is very easy. First two paragraphs I have added extra from my side. This is not in the standard. First two paragraphs is basically you should appreciate the importance of IFRS. IFRS is a global standard. There are two global standards. One is IFRS and one is US GAAP. But US GAAP is followed mostly in USA, maybe in some other countries also. But IFRS is followed in more than some 140 countries now. Means more than half of the globe follows IFRS. Either they have adopted IFRS or they have converged to IFRS. Ind AS that India follows is a converged version of IFRS. Means IFRS is taken as a base, and according to Indian economic situations, business situation, certain differences have been created which are called carve in, carve out. Nowadays the world is becoming a borderless world. There is a free flow of man, material, capital. Investor need to understand the financial statement better. Okay, if they want to put their money in some company, they would like to understand its financial statement better. When we didn't have a common standard, an investor from say Britain will find it difficult to understand a financial statement which is based as per accounting standards in India. So what we used to do? We used to convert the accounting standard based financial statement into IFRS based financial statement. But that requires a lot of time, energy, efforts. Okay. Because their policies are different. Accounting standard policies may be different. Then countries thought that why don't we have a common standard? So that it doesn't matter whether this is a balance sheet of an Indian company, Japanese company, Chinese company or a UK company. We can compare the numbers. Only thing you have to convert into one single currency, and then the comparison will become easier if the treatment for similar transaction is given in a similar way. So because now world over more and more countries are using the same standard, investors can now easily understand the financial statement, compare the financial statement, and take a decision whether to invest or not in a particular company or in a particular country. Is it right? Governments have also understood this, and that is why Indian government, they made companies to follow Ind AS, which is a converged version of IFRS. Otherwise, raising of capital was becoming little difficult for the Indian investor. The foreign investors will say, no, I don't understand your balance sheet, P&L account. I don't trust your financial statement. Is it right? Now what we will do? We will have to take the help of some international firms who will convert our financial statement into their currency and their standard. Now imagine if a company is listed in US stock exchange, British stock exchange, Indian stock exchange. What they will have to do in this case? They have to prepare financial statement as per accounting standards in India, as per US GAAP, as per IFRS. If you work in such accounts department, you will not get a chance to sleep also. Throughout the day, you have to just keep on preparing under different set of standards. Okay. So IFRS solves such issues by having one standard. It is like one language. If in a room there are 3 persons, one is speaking Chinese, one is speaking English, one is speaking Spanish, they won't be able to communicate. But if all of them speak the same language, then the communication will become easier, right? So this example of language is just like IFRS. One standard makes it easy for everybody to understand. Cross-border transfer of capital, etc. becomes easier. Investor becomes more confident in investing. So what are the benefits of IFRS standards? First of all, IFRS are high quality, internationally recognized set of accounting standards, because there are IFRS committees, bodies, and they do extensive research. Okay, they hire people, professionals from different big firms, and they do lot of time, give lot of time, energy in doing research on what is the coming trend and what is the prescription that we should give. So you must have observed, based on your knowledge of Ind AS, that earlier there was a standard on revenue, Ind AS 18. Now you have Ind AS 115. Because they knew that now business models are getting so complicated, it's not simple that you go and buy a product, pay the price, and the matter is over. When you buy a product, the party gives you warranty, he gives you some free cashback, some post-sales service. It means you are not paying just for the product, you are paying for service and warranty, and there is a cashback. This should also be accounted for somewhere. Is it right? So considering that the business models are changing, the standards also gets revised. And IFRS are internationally recognized set of standard. Globally, as I have told you, more than 140 countries now, either they have adopted IFRS or converged to IFRS. So the explanation of this is IFRS standard addresses the challenge by providing a high quality, internationally recognized set of accounting standard that brings transparency, accountability, and efficiency to financial markets around the world. Second benefit is international comparability and quality of financial information. Already discussed with you, if all countries follow the same standard, you can easily take the balance sheet of, say, British Airways and compare it with Jet Airways. Even though they are in two different countries, but if both are based on IFRS, they are comparable. Okay. So financial statement of different countries will become comparable. An investor wants to invest in, say, Brazil or India or Japan or China. So what he will do, he will ask for financial statement. If they are based on same standard, he can compare the performance easily, financial position easily, and accordingly he can take the decision. So IFRS standard bring transparency by enhancing the international comparability and quality of financial information, enabling investors and other market participants to make informed economic decisions. The third benefit is that it reduces the information gap. What is the meaning of information gap? On one hand we have management, on the other hand we have investors, the shareholders. management has lot of information which earlier the investors did not have. Now if you see, these standards require you to give more and more disclosures. As you have studied in Ind AS in accounting group 1 accounts, financial reporting subject, lot of disclosures are given. So when you give lot of disclosures, what you are actually doing? You are bridging the gap between the information which the management has and the information which the investor has. For example, segment reporting. What you are doing in segment reporting, you are actually sharing your internal data with the investor, that these are my different product lines, these are my revenues from each product line, profit from each product line, margin on each product line, which are actually confidential information. But the standard requires you to disclose that, and you have to comply with that. You are a public listed company, you have raised funds from public, okay? And it is also important for regulators around the world also. Now globally, even those who regulate the businesses, for them also understanding the financial statement will become easier. For tax authorities, okay, for law making authorities, because same reason, if financial statements are based on different standards, they don't know exactly what is the implication of this transaction, how much revenue is taxable or not taxable, whether subsidy should be given or not, or whether this party has committed some fraud or not. So even the regulators are happy, but they need to be trained first to understand the IFRS, etc. But over a period of time, the regulators will become well informed about all standards, and then so many cross-border transactions which takes place, they can also be regulated. It brings economic efficiency. Investors have wealth, money, and they want to invest. Where would they invest? They will invest where they have better opportunities. So if the financial statements are based on a comparable format, they can easily identify where they have a higher opportunity to earn. So therefore it will help in proper allocation of capital. It will force the company to become more efficient now. If you want to become a truly global company and raise funds from abroad, then you have to become efficient, because the investor has now the ability to compare. Is it right? One more benefit is, for companies, it reduces the cost of raising the capital. If your financial statements are already based on IFRS, then you don't need to hire big consultants and pay them a huge consultancy fees just to convert your financial statement into IFRS. Second, you can easily approach the investors confidently and bargain for a lower rate of interest, lower cost also. Even the reporting cost will reduce. I have seen companies converting their Indian accounting standard into US GAAP, IFRS, and imagine if it is a listed company, then this whole drama continues for 4 times in a year. Quarterly reporting. Is it right? Many accountants used to leave the job only because of so much of workload. Now we'll begin IAS 1. IAS 1 is presentation of financial statement. Very easy standard. Not too many numerical questions here, because we are going to basically understand what are the presentation requirement in financial statement. Financial statement is ultimately a summary of what the entity has done, achieved, asset, liabilities it holds, okay, which goes to the investor or the stakeholder, and by reading this financial statement, he is able to take an informed decision. So therefore this statement has to be prepared with utmost care and in a very presentable format, so that investor can understand and take appropriate decisions. So the example which normally I give you, why we need a standard format or some standardization here. is like, suppose you want to eat a dosa. There are two choices. You can go to a street shop and you can purchase dosa. He will charge you 60 rupees, 100 rupees. Okay. But then you can see how he decorates his dosa. He will just take some kind of plate, totally unwashed, partially unwashed, okay, maybe washed, and then he'll just put some chutney, some sambar, and then he will give it to you. And you can try the same thing in a 5-star hotel. First, a beautiful lady will take you to the table, okay, well decorated place. First, they will serve you a lot of goodies before you actually order, and then they will decorate it well. There you pay only 700 or 1000 rupees per dosa. Okay. Same thing happens with financial statement also. If you disclose your financial statement well, you can actually impress the investors, and then you can bargain a better price. Is it right? Same thing for student also. If you present your answer very efficiently, you get some extra marks because of that. It makes the examiner happy also. So the whole idea of IAS 1 is presentation. Presentation pays in today's world. We don't pay for the content sometimes. Sometimes we pay for the presentation. Is it right? But of course, in this case, we have to have a lot of content also. IAS 1 sets out overall requirement for the presentation of financial statement. So what is the scope here? We are going to understand presentation of financial statement. IAS 1 will give you guidance for their structure. What are the content, elements, in which sequence, etc. you have to write. And this standard gives you underline minimum requirement. Minimum means you can give this much at least. Can we give more than that? Can I disclose anything more than that? Most welcome. Investor would love it. Investor would like more information. Of course, the information should be given in such a manner that it should not be burdensome for them. So minimum is in IAS 1, but some extra information if you want to give can be given. It requires an entity to present a complete set of financial statement. Complete set of financial statement means what? We'll discuss in some subsequent paragraph, but it means SOFP, statement of financial position, which we call balance sheet. This is one difference between Ind AS and IFRS, but this is a very minor difference, name, nomenclature. Then we will prepare one SOPL and OCI, statement of profit and loss and other comprehensive income. Cash flow statement. Cash flow statement. One SOCI, statement of change in equity, notes. So usually these are the 5 items when you present is called a complete set of financial statement with all the details required by this standard and other standards. With all the details required by this standard and other standards. And how many times you have to present? At least annually. But of course, if you are subject to some regulation, and if the regulation requires you to present more than once, like a listed company have to give quarterly results also, so they can do it more than once with comparative amounts for the preceding year. So you have to give current year figure and comparative amount for previous year. Even in the notes, you have to give the comparative figure of the previous year. For example, segment information we give in the notes, but we have to give the segment information in the notes also for the previous year. So this is complete set of financial statement. The standard deals with the elements of financial statement. the structure, what will be the format, what will be the content. After some time we will see what is the requirement of balance sheet, statement of profit. I may use the word balance sheet, but you please interpret it as SOFP. For so many years we are taught balance sheet word only, and now after so many years we are asked to use the word statement of financial position. So as a student, you please understand, when I am saying balance sheet, I am saying SOFP. But while writing the answer in the exam, in GFRS paper you have to write SOFP, and in Ind AS paper you have to write balance sheet. Okay, other names are more or less same. The recognition, measurement and disclosure. Does IAS 1 deal with recognition, measurement and disclosure also? It deals with disclosure to some extent, yes, but recognition and measurement will be covered by specific standards. So standard on leases will cover the lease related matter. Okay, standard on related party will deal with disclosures related to related party. So disclosures are covered in this standard also to some extent, but disclosures are covered in other standards also. So those will be followed as per their respective standard and the interpretations. Right? Now every standard will begin with either introduction or scope paragraph followed by definitions. What we will do in this batch, we will discuss the important definitions which will have an impact on the remaining part of the chapter. Okay, those definitions which we will cover in one particular standard, we will not repeat in the other standard. Keep that in mind, so it will save our time. And as a good suggestion, every day once we complete a particular standard, you should revise it. It will help you in your group 1 paper also if you have not yet passed that paper. Impracticable. There is a term used in this standard called impracticable. Why this term has been used, I will tell you. Impracticable. These standards are not allowing the management to deviate from the prescribed standard. Okay, it is not like our earlier guidance note type of standard where you are allowed to deviate some point. You cannot deviate. Whatever is mentioned in the standard, you have to follow. But in only very exceptional situation, you may deviate from the standard. Okay, that is when it becomes impracticable to apply the standard, even though you have taken all reasonable efforts to do so. Okay, many standards says you have to apply fair valuation, but then you can't find the fair valuation of those particular, say, asset or liability or derivative or whatever is that instrument. Then maybe you can just apply the cost. So you have to ensure that you have taken all efforts to find the fair value of that item, but you could not. So hence I had to deviate. But again, we will see a separate paragraph on when you are allowed to deviate and when you are not allowed to deviate, and what will you do in that case. So definition of impracticable means applying a requirement is impracticable when the entity cannot apply it even after making every reasonable efforts to do so. For example, finding the fair value of an instrument, because there may not be any fair value available and you don't have expertise to find the fair value of such items. Okay. Next is, what are IFRS? What are IFRSs? IFRS are standards and interpretation adopted by International Accounting Standard Board. In India, we have Accounting Standard Board, and globally, the entity, the body which is responsible for issuing IFRS is called International Accounting Standard Board, IASB, and It comprises of International Financial Reporting Standard IFRS, International Accounting Standard IAS. The first 41 they have issued were given prefix of IAS. After that IFRS, because there was some administrative change in the body, and then this new body has started using the prefix IFRS. The third is interpretations originated by the International Financial Reporting Interpretation Committee or the former Standing Interpretation Committee. This also I need to explain briefly. Like accounting standards you have studied has accounting standard interpretations. You might have heard of it in the intermediate syllabus. Accounting standard interpretation gives some explanation about certain things which are covered in the standard but not clear from the standard. Similarly, here also you can imagine we are dealing with international standard. Everything cannot be covered in the standard. So the explanation is given through IFRIC. So we will call it in short IFRIC, which is the interpretation originated by International Financial Reporting Interpretation Committee. So IFRIC is the interpretation of IFRS. This you link. And SIC is the interpretation of IAS. So when international accounting standards were being issued, the interpretation was issued by Standing Interpretation Committee and it uses the prefix SIC. But when IFRS was issued, the interpretation was issued by this committee and now the prefix is IFRIC. Okay, they are also part of your syllabus. All the important IFRIC and SIC will be part of your syllabus. But then you will say, sir, we have not studied this in the Ind AS Group 1. There it was given in the form of appendix. This IFRIC and SIC appears as appendix at the end of Ind AS. So some of the important ones are covered in the classroom exercise. Now next is what is material. Material, as you have been learning from 11th standard accounts, means these are those items whose omission or misstatement individually or collectively can influence the economic decision that users make on the basis of the financial statement. Same definition from 11th standard accounts book. That means something which should have been written but not written, or something which is wrongly written may affect the decision of the user of the financial statement. Is called material item. But what is material is a subjective concept. So materiality will depend on the size and the nature of the omission. So if the MD commits a fraud of 1000 rupees also, it becomes a material item. Is it right? But if a small employee in the stores, if he steals 1000 rupees certain thing and the company's turnover is 1000 crore rupees, it may not be that material that you need to put a separate note on that in the notes or in the balance sheet or P&L account somewhere. Materiality depends on size, what is the amount, nature of the omission or misstatement, judged in the surrounding circumstances. So it depends on what is the type of mistake, what is the type of item. Okay, for small company, 5000 rupees repairs and maintenance. If written under the heading traveling expense, is not a material item. For a big company, for a very large company. But for a small company, it may be important because they might be analyzing their expenses. Where are we putting our money? Is it right? So that is material. Payment to auditor has to be presented separately. So it's a material item. Payment to directors becomes a material item. Fraud, etc. committed by director can become a material item. So who has to take the judgment about materiality? The management. What information should I give so that the investor can take a proper decision? The size or nature of the item or the combination of the both could be the determining factor. So it is all dependent on management. What do you mean by notes? Notes means at the end of the balance sheet, P&L account, statement of change in equity and cash flow statement, what we do, we give lot of information in addition to what is presented in statement of financial position, statement of profit and loss and cash flow statement. Everything cannot be contained in the SOFP, SOPL or cash flow statement. Is it right? Some more information are required to be given. For example, certain things may require explanation. How the EPS is calculated is to be given. Will you write in the main page of P&L account or you can explain it? Notes. Then you have to give accounting policies. You can give in the notes. In the main SOFP, you will give a total figure. But the breakup of those figures will be given in the notes. Say for example, inventory will appear in balance sheet. But what is the breakup of that inventory? How much is raw material? How much is WIP, finished goods? Will come in the notes. Okay. And information about items that do not qualify for recognition in those statements. So any other information which will not be appearing in SOFP, SOPL, statement of cash flow can be given in the notes. In fact, nowadays the size of the notes is many times more, not more, many times more than your balance sheet, P&L account, cash flow statement, etc. Okay. Because most of the disclosures go in notes. Almost every standard which have recognition and measurement principle will also have a disclosure paragraph. If you don't have a separate disclosure paragraph, there is a separate standard on disclosure. Like financial instrument 10 IFRS 7 is a statement only on disclosure of information about financial instrument. Is it right? Yes or no? Yes. Who are the owners? Owners are the holders of instrument classified as equity. What is profit or loss? Profit or loss is the total of income less expense. So it is income minus expense, but it will not cover components of other comprehensive income. What is other comprehensive income? Just first quickly I will tell you that in Ind AS or in IFRS, the statement of profit and loss account and other comprehensive income has two parts. Part 1, Part 2. Part 1 is called profit or loss, profit and loss, and Part 2 is called OCI. Here we write items of income and expense. Usually these are recognized items. These are recognized items. And usually these are unrecognized items. For example, revaluation gain is just a book entry. Many gain or loss relating to financial instrument. So most of the gain or loss which earlier you might have studied in 11th, 12th standard directly used to be written in the reserve. Now they don't write directly in the reserve. First they present on the face of the statement of profit and loss and OCI, so that the investor will know that these are the gain or loss which they have realized and these are the gain or loss which they have not yet realized. And accordingly it will help them to take a more informed decision. So this is OCI, other comprehensive income. This statement together is also called statement of comprehensive income. Statement of comprehensive income. Okay. In IFRS, there is a very important difference between Ind AS and IFRS. This is one way of presenting your comprehensive income, where in the same statement you will have two parts, or you can give separate statement. One statement which they will call SOPL, and one statement which they will call SOPL and other comprehensive income. So these entire items they will transfer here. The net profit that you will get here will become the first line item here, and these entire items will be transferred here. It's again a matter of just presentation. Figures will remain the same. Okay. So OCI comprises item of income and expense including reclassification adjustment. Reclassification adjustment I will discuss after a few minutes. Reclassification adjustment means those items which will be subsequently transferred to profit and loss account. So right now they are unrealized, but they might get realized in future. So they will get transferred from OCI to PL. Okay. Like for example, foreign exchange difference. Till it is unrealized, you put it in the OCI. If it is realized, you shift it from OCI to P&L account. Next is total comprehensive income. Total comprehensive income is the change in the equity during a period resulting from transactions and other events other than those changes resulting from transaction with owners in their capacity as owners. So it's basically, you can say, total comprehensive income is the total of part 1 and part 2. Change in the equity. Equity will change only due to two reasons. One is either you have made gain or loss, or you have done some transaction with the owner. So total comprehensive income will include all such events and transactions which will change the equity owner stake, but excluding transaction with owner. Any example of transaction with owner? Issue of share. I am giving the example of this item. Issue of share will also change the equity. Buyback of share will also change the equity. Dividend paid to shareholder will also change the equity, but they will not be called comprehensive income or total comprehensive income because these are transactions with the owner. So we are talking about dividend paid to equity shareholders, not dividend received. Total comprehensive income will comprise all components of profit and loss and OCI. And what is reclassification adjustment? Are amounts reclassified to profit and loss in the current period that were recognized in the other comprehensive income, either in the current period or in the previous period. OCI have two types of item, which we'll discuss below after some time. For the time being, to understand this paragraph, those which are subsequently transferred to P&L account and those which are not subsequently transferred to P&L account. So we are talking about such items which were once classified in OCI because they were unrealized, and now in this current year it got transferred to profit and loss account. So it might be recognized in OCI in current year, or it might have been recognized in the previous year. So even if it is current year, you will show it as a deduction, less transferred to P&L account. Is it right? Or if it is in the previous year, then also you will write accordingly. So now we'll take a small break, and then after that we will start with the detailing of what you will include in the different elements of financial statement. Okay.